Good afternoon, everybody. This is Wise here today, again with Lakshay. So today's topic is how to pay down your mortgage in 10 years instead of 30 years. So Lakshay, enlighten about this to our audience today.
All right, thank you very much. Good afternoon, first of all, for joining in. Let me just share my screen. All right, I hope everyone can see my screen now. Let's get started. My name is Lakshay. I am the Director of Finance with SaveMax Group of Companies. Today's topic, I wanted to touch base a little bit about real estate and all things real estate. A lot of you guys are realtors. A lot of you guys have been in the industry for a long time, and now you're looking for ways to kind of reduce your taxes, maybe refinance, or maybe even help your business take it to the next level, which might mean incorporation. So today's topic, I wanted to drive it back to the from the accounting industry to the real estate industry, and actually talk about how can we basically pay our mortgage faster. How can we pay it off in 10 years as opposed to 30 years? So a little bit of a twist, and I hope you're going to like our presentation today. Once again, I've been in the industry for past 8 years, primarily connected with real estate and real estate brokerages. We have two offices in Ontario. So if you want to, reach out to me later on after this slideshow, feel free to reach out to me at my phone number or email in order to, get your accounting, bookkeeping, or any tax planning needs. So let's get started. So the question is, what is the biggest monthly expense that is not tax deductible? So anyone who wants to participate? Mortgage, yes, you are right. So the interest on mortgage is actually not a tax deductible source. So what we're trying to do today is how can we deduct that interest on mortgage on a principal residence and use that to pay off our mortgage quickly. So hopefully this will be worthwhile. So in the US, it's actually for the principal mortgage, even all of the people can actually deduct it. So if you're in US, many homeowners are able to deduct a portion of their mortgage on their taxes and get the benefit. But in Canada, we all know interest on mortgage is not deductible, and it is one of the significant expenses that we have on a day to day. So why not use it to kind of not only minimize our taxes, but also pay down our mortgage faster? So the Smith maneuver, a lot of you might have heard of, by Robinson Smith and his father, is a legal strategy that effectively makes interest on your residential mortgage tax deductible. So the name of the strategy is called Smith maneuver after the person who founded it. A lot of the slideshows would end it, just a bit of disclaimer. A lot of the slideshow, a lot of the examples will be directly from their books. So feel free to refer back to the original book, The Smith Maneuver, if you want to read up more about this. In today's 30-minute session, I'll try to break it down for you and how you can get started on something like this if you are interested. So we all know there's an interest portion to the mortgage, as well as there is a principal portion to the mortgage. So which part, how much does it $750,000 really cost? Does it cost us $750,000 or more than that? We all know approximately with 30-year amortization, 4.5% fixed interest rate, how much will this technically be worth to us? Let's look at it. It will actually cost us $618,000 in interest over the span of 30 years, and $750,000 is the original loan. So eventually, a $750,000 loan will be costing you $1.3 million. That is something that is very, very essential for you to look at when it comes to, buying any property, that most of it or 50% of the cost is related to interest. So what could have costed you 750, now it's costing you $1.4 million with the interest approx 30 years. So yikes, in fact. So how do you use this interest portion as part of our tax deduction and make it worthwhile? The Smith maneuver can actually help us convert the interest on the mortgage into a tax deduction investment loan. So mostly whenever you have interest on the mortgage, that is not deductible on your taxes. If you have a rental property and you are using the rental property to generate business income, then it becomes a tax deduction. But for a principal residence, there is no tax deduction for this. So in this scenario, a Smith maneuver can actually turn your interest portion, which is non-deductible, into a deductible tax investment that can be used in future. So you can receive, annual tax refunds if you are claiming the interest on your mortgage, and it can help you reduce the number of years on your mortgage because you can use the refund and the investment money that you have gained to pay down your mortgage in lump sums more than just the traditional monthly payment. So what are the requirements for setting up a Smith maneuver? For the Smith maneuver, you basically need to set up a re-advanceable mortgage. We all are familiar with a traditional mortgage, but a re-advanceable mortgage is technically just an additional line of credit, which works like a home equity line of credit. A lot of you are realtors. A lot of you might have already heard or already have a home equity line of credit. But technically, what all it is saying is if you have a home and the equity portion is $400,000, on that $400,000, you can borrow money on the equity. So out of the 400,000, you can, as you pay down the $400,000 in monthly installments, your home equity line of credit will increase. So the loan goes down for the mortgage, but the home equity line keeps going up. So it kind of works hand in hand, which I'll show you in an example in future. Basically, it works great, and it is a legal system to kind of make your non-deductible interest on principal residence into a deductible investment loan. So how does the Smith maneuver work? You make regular mortgage payments into the just like you would do for any regular mortgage. This payment will basically reduce your mortgage loan every month. We all know that. The limit based on the re-advanceable mortgage, what would happen is as you pay down the principal on the mortgage, you get a line of credit increase dollar for dollar. So as you're paying down the loan, your line of credit is increasing because you're paying down a bit of principal whenever you're making those payments. So you can invest this newly available credit into higher performing assets. So of course, line of credit will have its own interest, but you can use the money to invest in your business, your stocks, or anything that is giving you a higher rate of return than your investment line of credit interest. You repeat that each month, and eventually you will transfer all of your mortgage into a home equity line of credit. Use that home equity line of credit to invest in the assets that are higher performing, and use that to kind of pay down your mortgage faster. So that is basically the overall strategy. Let me repeat what I meant by that. Smith maneuver is basically you get a re-advanceable mortgage. The re-advanceable mortgage works in one way where you have your typical traditional mortgage, you pay monthly interest and principal. As you pay more and more interest and mortgage, your basically outstanding mortgage goes down and down. But with the Smith maneuver, we have a re-advanceable mortgage where you have a home equity line of credit linked to this mortgage. So as you pay down the home loan, you are actually getting a higher home equity line of credit. So your home mortgage loan goes down, you get a home equity line of credit, and on this line of credit, all of the interest becomes deductible. All of the interest is deductible. You can use the money to invest into stocks, which is basically 50% down. So you can maybe, balance your portfolio, invest in stocks, invest in your business, where you will make far higher rate of return. And with that, you will be able to, beat the market essentially and, pay down As you get more and more return from your investment, you will be able to invest that money and back into your mortgage and pay it down faster. So let's look at an example with pictures. So a typical mortgage, once again, is a $400,000 mortgage. 100% of it is non-tax deductible. Now let's look at a readvanceable mortgage and how would that work. A a traditional mortgage along with a readvanceable mortgage. Right now, the line of credit is sitting at zero, and all of our loan is in this scenario $400,000. Both of them are, we have empty right now because one is we haven't paid anything in the loan of the typical mortgage. That's why it's showing 400,000 outstanding, and line of credit is zero. Now let's assume we make one payment in month number one. On month number one, we will have $2,200 payment where majority goes to interest and a small portion of it goes to principal. So outstanding loan from 400,000 drops to 399, but we get the $730 in line of credit. Overall, every month, this line of as you make more and more payments, the mortgage will keep going down and the line of credit will go down. So you look at month two, the line of credit is increasing. Month number three, the line of credit is increasing again. And what you are essentially trying to do here is this mortgage interest loan was non-deductible, but when you get it in a line of credit and you invest it into a business or a stock or something, or even a rental property, as a matter of fact, then it becomes an interest deduction. As you get more and more interest deductibility, you can use that against your tax payable and get a higher tax refund. As you get more and more money into your bank, you can use then that money to pay off this mortgage faster. So it's basically a rinse and repeat process where now you have paid down your mortgage overall, and it takes over time. What you would have done it in 30 years, you could have achieved this in 10 years. Why do I say you can save 20 years worth of time? It's because when you are making prepayments to the mortgage, there is factor of compound interest, which was increasing. So as you pay more and more towards your prepayment towards your mortgage, you will be able to bring it down to zero and use the line of credit towards the investment properties, towards the business, towards stocks, and basically use that money to kind of gain more interest than you would have paid on the line of credit by default. So you have achieved two purposes. One is you have secured yourself for the retirement by continuously reinvesting in the market. The second primary purpose is you have technically paid your mortgage faster. Why? Because when you were investing into the market, you were getting higher returns. With the higher returns, you were actually able to pay down your mortgage in lump sum far quicker than you were through the typical monthly installments that you were paying. So 100% tax deductibility comes when you are using the line of credit money to invest into business or stocks or something else. And when you get interest deductibility, of course, your tax liability goes down and you get a higher tax refund. So that is technically how you can use the Smith maneuver to, basically to your advantage. So I want to take a pause at this and see where things are. How far are people following me, or are they lost? We have almost 25 attendees, so I'm sure there's probably some questions.
So, Lakshay, this is Wise. Can you actually help our viewers to set something like this up?
Yes, absolutely. So if someone wants to, I got a question where someone is asking, can we help our viewers set something like this up? Yes, book an appointment and we can definitely help you out set up a Smith maneuver. And you definitely need someone, an expert, to set this up, because if you don't set this up, there's a very high chance of getting, audited by the CRA. And so make sure to get some advice when you're about to set this up.
Excellent. Thank you, Lakshay.
Lux.
Hi, go ahead, Manish.
Yeah. Hi, how are you?
Good.
The question is the interest of the line of credit Means suppose the mortgage is 4.5% in answer and line of credit 6%. So that 6% interest you will get the tax refund, right?
Yes.
Okay. So in place of suppose HELOC, so is a general line of credit, still you will get it, right? Or no?
A HELOC, you would get the deductibility, but what you would need to do is you would need to set it up as a re-advanceable mortgage,
Okay.
not a regular HELOC.
It's a re-advanceable mortgage. So you have to ask your broker, right? Like bank and then lender.
The bank as well as the mortgage broker and maybe the accountant, because each of these interest deductibility needs to be tracked separately in a different bank account if CRA was to ever audit it. So that is very important when you're doing this.
Okay, thank you.
Welcome. All right, so let's continue. So what did I mean by saying you can pay down your mortgage in 10 years rather than 30 years? So as you can see in this example, we have a monthly payment that was going. Out of the 1486, out of the 2200 monthly payment, 728 was going to principal and the interest was 1486. So 20 for 200 is approximately what was going on. As we pay down every month the line of credit or the mortgage, we have a spread where the principal portion is increasing every month. So you might be wondering what happens to that. We will stick to paying the same amount of principal every single month. The reason being the $2 difference or $3 difference is the additional money that we're getting that can service the interest on the additional line of credit. So the spread between monthly payments that is changing can be used to actually offset the interest cost of the line of credit. So essentially, you never have to input more money or you never have to increase your cash in the Smith maneuver. So that is very specific to this example that I wanted to highlight. Now that we understand what the Smith maneuver is, there's one more strategy that can be pooled with this, and that is the third last slide of my presentation, the cash flow dam accelerator. The cash flow dam accelerator is basically very useful for people who are sole proprietors or have multiple rental properties. I wanted to use this example because it is related to realtors and it is related to people in the real estate industry. So if you have a sole proprietor business where you're collecting rent and basically, reinvesting it in the market, the cash flow dam accelerator can also help you with not the investment side. The Smith maneuver was using the money to reinvest into the business and get a better return and then basically pay down your mortgage faster. The cash flow dam accelerator doesn't involve investing the money into the market. It is mostly basically reborrowing the funds to use in your business. So let's assume I have a rental property business where I'm collecting rent. When I collect these rent, I am basically paying down the mortgage, right? That would be the typical model. With the cash flow dam accelerator, what you can do is you can get a re-advanceable mortgage, same way as Smith maneuver, but with the $2,000 a month that you're collecting, instead of paying down the mortgage, pay it down towards your sole proprietor business expenses. When you're using the funds to pay down the business expenses, you are getting a bigger line of credit under the business and use the business funds to pay down the actual mortgage of the actual properties that you own. So instead of collecting the rent and paying down the mortgage, collect the rent, pay down the business expenses. Business expenses will give you an additional line of credit and use that line of credit to pay off the mortgage of the rent. So this can again be used, get yourself an interest deductibility, as well as involve your business into the accelerator program, which gives you higher cash flow. And it's basically two birds, one stone, because technically you were just paying the rent with the mortgage with the rent, but now you're using the rent money to get an increased line of credit on your business, as well as using the business money to pay the mortgage. So both of them gets the same impact. you get a higher cash flow, and you have the ability to kind of function freely. So in summary, Smith maneuver can help you reach your retirement goals faster, which means paying off your mortgage as well as setting up some sort of investment stock portfolio or investment rental property portfolio, which can actually set you up for retirement. Using these strategies can it's the compound effect that really helps you achieve the tax minimization as well as paying down your mortgage. So what is right now, you saw the first example where the $750,000 house was actually costing $1.4 million because over 30 years there was $684,000 worth of interest that we were actually also paying. So it is worthwhile to look into these strategies because there's significant tax savings, as well as you can actually use the funds to set yourself to financial freedom. Both Smith maneuver and cash dam flow effect were both legal strategies. They're not something that is they're not illegal. They're legal. They're recognized by CRA as well. One thing I would want to suggest you is, I didn't have a lot of time to go in depth, but this is just at the surface level. I wanted to introduce you guys. Speak to a professional before setting this up, because this can involve if you don't set it up correctly, your CRA might as well reject the whole scenario in this, and you might not get the deduction that you're looking for. So thank you guys once again for listening. I'll open the board for questions if someone has any.
Looks like there are no other questions from either side, Lakshay.
I do have some questions that I was going through.
Okay.
Someone has mentioned that a HELOC can be set up by Scotiabank. Yes, Manulife can also administer this as well. Jaspal had a question in regards to, if we use the LOC to buy pre-construction investment, is the interest paid on that amount also deductible? Yes, because it's an investment property, it will be deductible. You can also take the invest from B2B bank or other. Any downsides to negatives online smooth maneuver? Investor effects. Please send me a presentation. Someone is asking for a presentation, and I can definitely share the presentation. Shoot me an email at support@accountingops.ca. I'll be more than happy to share that. Someone is asking, what are the positives and negatives of this strategy? There's lots of positives and negatives towards this strategy, but what I would want to suggest is sit with this professional and go through the entire strategy and see if it actually makes sense for you. It might not be beneficial for everyone, and it might not be bad for everyone, right? So if you want to go in depth, I would suggest set up a one-on-one with me, and I can walk you through what are some of the positives and negatives on this. The Smith maneuver, there's a lot of information online as well that you can read up on about this. The basic strategy that we need to keep in mind is we are technically using the money from the LOC to invest and get greater return. If the market has crashed like it has, right, there's a 20-25% correction, you might not be able to find assets or businesses or stocks that are performing higher than what your basic interest rate that you are paying on the line of credit. So that is the negative impact, where there might be a couple of years where you might not be able to. Your rate of return on the investments might be lower than what you might have been getting from the regular from your day-to-day activities. So if the investment loan that you are investing in the market is lower, the Smith maneuver can technically backfire. So once again, thanks for all of the 25 attendees to join in today. And if there's any more questions, I would like to answer them right now. Otherwise, I can call it a night, and I'll see you next Tuesday, 2 p.m.
Thank you, Lakshay. Thanks for the session again. We'll end this telecast now. Thanks.
Perfect.